Okay, here we are. Welcome, everyone. Thank you so much for joining us live this evening to our Introduction to Business series. Tonight, we're going to cover key considerations for business financial statements. So, thanks again for being here. Just a little bit about myself. My name is Joanna Mummert, and I've been a financial coach for the past 20 years. And I began supporting small business entrepreneurs in 2015 as an instructor for English and Spanish business courses offered, offered through Ventures. And Ventures is a Seattle-based nonprofit organization that empowers aspiring entrepreneurs with limited resources and unlimited potential. We provide access to business training, capital, coaching, and hands-on learning opportunities for entrepreneurs. So over the last few years, with the pandemic and all the different things that have happened as a result of that, I've been providing additional support to Seattle area business owners recovering from the impact of the pandemic. And so we at Ventures are excited to partner with BECU in this training opportunity. This is the third of 4 webinars. So I want to take a moment to mention if you missed either of the first 2, I would highly recommend going to the BECU YouTube channel to watch the first 2. Everything that we're doing is kind of progressing along. So absolutely recommend that you go back and listen to the first 2 topics. So anyway, BECU is focused on helping their business members succeed financially in all aspects of their business journey. And part of that success is offering the education and information businesses need to make crucial business decisions. So through partnering with Ventures, BECU and Ventures together can provide content and education to their members and prospective members. And BECU hopes to reach far into the communities that they serve to provide free and relevant information to every business and to every person with a dream of business ownership. So BECU is people helping people. So welcome to everyone who's here. This evening, we have got about an hour together, and I just want to go over our agenda. You'll see we're going to cover a few different topics that are pretty big topics. The importance of accurate record keeping, types of useful financial documents. Those are the 2 big ones because we're going to go deep into those topics and especially focus on the specifics of those individual financial documents that are so valuable for a business. And then we're going to wrap it up with, I'll mention a little bit about some things that are important to consider when doing business with cash. And also we'll talk about where to go for help with time at the end for Q&As. So being the sole presenter, it's going to be a little bit hard, I mentioned, for me to navigate between the chat feature and being able to keep my train of thought going on the chat, on the presentation while answering questions in the chat. So maybe if you think of something that comes up, if you just jot your question down, then if there's a moment where I can pause and open it up for questions, I will do that. Otherwise, I will save time at the end for questions and answers. We do have plenty of time to address everything that may come up this evening. Here is my disclaimer. So as the presenter tonight, this content is provided for informational purposes only. I'm not an accountant, I'm not a tax attorney. So I always recommend, please consult with a state registered accountant for tax advice, because I can't give specific advice, but hopefully point you in the right direction and give you some really important things to consider and think about. So no matter where you are in your entrepreneurial journey, one of the big things is understanding record keeping and reporting and why it's so important to have a handle on that. So financial statements, understanding them and being able to develop them really is an important skill, but it's a skill that you can develop. So well, usually when I'm teaching a class and we get to finances, it's exciting because entrepreneurs, they've got their business ideas, they're excited about the marketing. You as entrepreneurs are good at what you do. The product that you make or the service that you provide, that's what you're really good at. And maybe the record keeping, the bookkeeping, and doing the financials part, maybe that's something that isn't a skill that you've really developed yet. Or maybe it's something that you're just not, maybe you're not excited about it. Or maybe it's one of those things where you find it challenging. So I want to break it down into those little bite-sized pieces this evening so you can realize that as entrepreneurs, just having an understanding of what those documents can do for your business can really free you up to focus on what you're best at. So I have on the screen here some points that I think really highlight the reason why you want to have good records. And the first one you'll see is that it helps you budget. Well, when you are budgeting, what does that do? It helps you understand how to finance something that you may need to purchase for your business. So I like to use real examples. And if I think of a business that maybe owns, or excuse me, that's a restaurant or a catering company, for example, if you know where you are today and you're working on a budget of where you need to go in the future, if you need to purchase something like a walk-in refrigerator, for example, and that walk-in refrigerator, you've looked around, you figure, oh, it's going to cost about $18,000. That's a significant expense for your business. And so you could either go into debt to make that purchase and make sure that you can afford the payments, or you can take out, you could put together a plan to save up to make the purchase in the future. So either way, you're financing what you need to purchase for your business, and budgeting will help you get a handle on the cash flow so you know what you can afford. Tax preparation. Well, if you have good records, it could send you time and money when it comes to sending in your tax payments or doing the necessary reporting that you need to submit. And one accountant once told me the thing they hated most was when a business owner has a box of, like a shoebox full of receipts and says, okay, here you go. Here's what my business has done the last 3 months. Well, they can do it, but what is it going to do? It's going to cost a lot more money to have somebody else organize it and put it together for you. And it's just not as efficient. So it'll really help you with tax preparation. Easy reporting. Different people, different organizations may request different types of financial documents to demonstrate the strength of your business. And so that could be maybe your landlord, if you're taking out a business lease. It could be a lender. It could even be a government or private entity that's awarding some grants or government contracts. So there's different benefits to having good records for those types of situations. Financial management. Well, when you have good documents, then you can show in a very accurate way the financial strength of your business. So you can be able to show where you're at any given point of time. And it'll give you also not only a sense of where you're at and where you're going, but it makes decision making that much easier when you know how you measure up. And then the last one, the last item on this slide, track profit and growth. is that very same thing as well, where it makes decision making easier because you can see if you are on track when you're looking at the big picture of where you are, if you're comparing your business sales to from this year to last year and so forth. Perfect example with that. If you haven't felt it, but if you look back in 2020, for example, a lot of businesses had to shut down for a few months. And so knowing what impact those closures made on your overall profits and overall cash flow, having an understanding of that and knowing where you're at any given point in time helps you realize what you need to do to catch up to get back on track. There are so many different uh, tools that are at our fingertips now with web-based software or a financial app that you can have on your phone. A lot of programs are cloud-based so that you can access them from anywhere. Some of them are, you download it to your computer and use it on a daily basis from your actual computer itself. You could hire somebody to help you with a bookkeeping service, or you can use online templates to do it yourself. But I think the main thing is that you choose one that fits your needs. And if you need to make a switch later on, it can be relatively easy to do as long as you keep yourself really organized. And organization really is going to be the key to everything. And so understanding where you're at and what your numbers are and having it in a place that is accessible and backed up is really important. I don't know about you, but if you've ever looked at receipts that you've kept from years back, what do receipts have on them? Disappearing ink. So the ink fades. The ink fades. So if you're going back to look to see what you had, where you had been spending your money at any point in time in the past, if you haven't gotten it recorded somewhere else or a scanned photo of it, you may have lost it. You may have lost it forever. So keeping good records requires also having backups so that you can find more than one place, find the information that you need in more than one place. Okay, so here are this is like our fun list that we're going to go through today with useful business financial documents. So we're going to talk about each one individually. We're going to go over your business plan, or what a business plan would look like, balance sheets, your business debt schedule. We're going to talk about profit and loss statements, and we're going to cover cash flow projections. So do not worry if you have one of these items or if you can check off all of them. I'm hoping that some of the information that I'll share is going to be new information for you. That's the goal, isn't it? That it's new information. But you'll see also that, wherever you're at in this journey, there's always room for improvement. And you can always go back and make your existing documents better. So the business plan itself, a lot of people don't think that the business plan is necessarily a financial document, because it's not all just numbers, but it is pretty foundational to everything that you do with your business. So if you don't have one, or you haven't reviewed your business plan in some time, I would like to encourage all of you to do that. And so I made a list here of what are the important parts of a business plan. You want to make sure that each of these items are updated. So when was the last time that you looked at your business plan? That's my first question to you. And if it's been more than 2 years, I'd say, hey, take another look. Take another look and see what you can change and update. And a business plan doesn't have to be super complicated. and maybe it'll be between 15 and 20 pages. Doesn't have to be too long, but I've put together the list here of what a good plan will include. So the executive summary is the first item, and that is going to serve as your concise overview of what's included in the plan. So it's usually under 2 pages, and it'll usually have it'll describe each section. It's going to summarize each section that's going to be in the plan in a few sentences. So it's putting it into a bite-sized piece of what the entire plan or the entire business plan is going to include. The company description, that's going to list or describe what your product or your service is. You're going to mention here how long you've been in business and give an overview of what your vision statement is going to appear here. Where do you see your business going? What does your desired future state look like? So the vision statement is going to be included in that initial section before you move into the numbers. You want to paint that picture of where you want to go visually. So the marketing analysis is going to take what your product or service is, and you're going to define your ideal customer in this section. Who are you selling to? What are their needs? What solution are you providing them? How are you going to make their lives better? In this area, you're going to mention not only who your ideal customer is, but how you are going to reach them. How are you going to get in front of that particular person? And what are some ideas that you have to do that? That will then segue into your competitive analysis, where you introduce who your key competitors are. That could be a competitor that's demographically in the same neighborhood. If you're an online business, who would be taking money away from your potential sales? Who are you in competition with? Who's selling something similar? Then, one other thing to mention here in competitive analysis is what makes you unique. And when we're teaching a class, just so you know, I'm going over this with very generalized, bird's eye view, because whole courses are offered on all of this information. So I'm not going too deep into it, but I think it's important when we're looking at the competitive analysis, something that sometimes gets overlooked or not as well illustrated is this idea of uniqueness. So each of you who are here have a skill, an art, a product that you create or provide that you're good at. So something about what you have is going to be that unique product or service that you're trying to bring to market to your ideal customer. And this is where you want to mention that. What makes you different and how do you stand out? Because really that's going to be the key that's going to drive a lot of your success, is the ability to communicate your uniqueness to your key customers. And then the organizational summary section is where you would address who are the owners of the company, who are the managers, and what special skills did they bring to the table. And then the last part, financial plan, that would be where you would include the documents that we're going to be going over here with sales projections, any future sales goals that you have, any expectations that you have. It's going to be wrapped up in that section. So we're going to first take a look at the balance sheet. So a balance sheet, hopefully you all have at least heard of this term. The balance sheet is going to basically divide your assets and your liabilities. It's a financial picture of a snapshot in time of what the company owns and what it owes. So the ownership is in the assets, and what is owed is going to show up in the liabilities. So under assets, the things that the company owns, the first thing, cash and cash equivalents. So cash is easy. We know that's like your checking and savings accounts, money on hand, money that's right there ready to spend. But cash equivalents, that might be something like a money market account. It's going to be whatever you can easily convert into cash, and it's highly liquid. And when I mean liquid, it means that you can sell it and get it into cash immediately. So money market account is very much that. It's almost the exact same as just using a savings account, but there are some slight differences. Another example would be a bank CD. So CDs are easily converted to cash, and they're very liquid. You might have a time frame as to when you can liquidate without penalty, but those would be considered a cash equivalent. Also in that category is a U.S. Treasury bill, which also tends to be low risk. Accounts receivable. Well, accounts receivable, that's going to be money owed to the company for goods or services delivered, but not yet paid for. So you have a customer who you delivered your product to, but they haven't paid you yet. Inventory, that's the total value of all unsold goods. And illiquid property is anything that would take longer than 30 days to liquidate, sometimes longer, but illiquid, think of anything like a vehicle would be considered illiquid. If you own real estate in your business, that would be illiquid. Anything where you have to find a market to sell it, that would be considered illiquid. It's still an asset. It's just that it takes some effort to turn it into cash. Now, on the flip side, liabilities, again, everything is the money that you owe. So the first thing on there is debt. Super easy. We already know, okay, if I have a loan, it's a debt, it's money I owe. So any outstanding loans fit into there. Accounts payable, unlike accounts receivable, but it's kind of the flip side of that, is where the business has received money or payment for something that you have not yet delivered. And that could be a good or a service that you still need to deliver. Employee retirement plans. Now, this is an interesting one that maybe you haven't thought of before, but employee retirement plans, that as a liability could be that you are realizing that you've got some deferred compensation. You're going to owe one of your employees money into their retirement plan. Maybe you do a matching and you know that they regularly put in a specific amount of money each month or each paycheck. You can plan accordingly, knowing that you're going to have to put that money aside for them. If you have any type of, usually it's the bigger companies that have a pension for their employees, or if you're going to have any retiree benefits that need to be paid for. That's where all those items would go under the employee retirement plan section. And then a deferred tax liability, that area, or what you would include in that section, is any federal or state or local tax that is due, but you haven't yet paid it. So that could be various things. One easy one is, let's say you owe taxes from the previous years and you're on a payment plan, for example. You're paying a little bit as you go. you've got the price tag, you know how much you owe, and you know what that balance is going to be, but you've been paying on it little by little. Another one would be if you filed an extension to pay your taxes and you know more or less, okay, I'm going to have to pay this much by this date, then you can plan ahead, and that's going to be a tax that's owed. So all of those things are going to fit in your balance sheet. And just like the name implies, both sides have to balance. So the assets and the liabilities are going to balance out, because on the liability side, you're going to show for every asset that you own, looking at it as a whole, you've got to have a corresponding equity or liability to balance it. So for example, let's take a look at the sheet that I have on the screen here. And I like it because it's side by side, so it's easy to kind of see how things are laid out. So on the asset side on the left, you have a listing of the current assets. Got a checking account, savings account, petty cash, accounts receivable, inventory. All the current assets are listed out. Non-current assets are some more technically, those are a little bit more technically advanced. They're perfect for an accountant to go over with you. But the total assets, the total value of what the company has is 177,000. So the rule of thumb when you're dealing with a balance sheet is the assets have to equal the liabilities plus the equity. So everything on the right-hand side is going to show the listing of all the liabilities, all that money owed, all of those things that we just went over, plus any equity that you already have in those items, so that the total is going to balance. So 177,000 on one side and 177,000 on the other side. So this balance sheet, one of the important things to kind of realize is that this balance sheet, or a balance sheet for your business, is going to reflect your company's performance since its inception, because it's taking all of that into account. Because if you've acquired assets over time and you've acquired and built equity in your business, the current state of where you're at is going to reflect that. So all that historical investment, time, effort, sales, everything is going to basically bring you to the balance sheet of where you're at today. This sheet is often used when lenders, for example, are trying to look at your debt to income ratio when it comes to whether or not you have the ability to pay not only current debts that you have, but for future debts. So if you're looking at taking out a business loan, this balance sheet is going to help really paint that picture for the lender, for the underwriter, so that they can see, what is your debt to income ratio? What does it look like? What are your assets versus the liabilities? And it's going to help paint that picture for them. Okay. We're going to go on to the next one, but I'll pause right here because this is a good point. Good spot to pause. Does anyone have any questions up to this point? If you do, you can certainly take yourself off mute. I think Michal has a question.
Yeah, thanks. Hi.
Sure.
Yeah, this part always gets me.
Yeah.
That it balances, right? Is that just
Yes.
a magical thing that you just say, okay, these are all of my assets, and this is, and these are my liabilities, and wherever it doesn't match up, that must be my owner's capital? Or I'm not sure.
So just FYI, remember my disclosure at the beginning, I'm not an accountant. However, speaking from like my experience, kind of going back, usually usually it's going to show up in your equity, right? Because if the value, you're looking at the value of something, and if what you own, so it's so easy to talk about a house, for example. And so if you look at a house, you know what you owe on it. That's a given. That's a set number, right? That what you owe on your mortgage is not going to change, right? You can see it, it's concrete at any given time according to your debt schedule. You know what that amount is that you owe. The market value can change, right? The market value is going to can fluctuate a little bit, and it's going to depend on what someone's going to pay for it. But with those two figures, if you know how much someone's going to pay and you know how much you owe, you can calculate the equity, right? So I like to think of when you're looking at owner's capital and business equity, like to think of it the same way, in the sense of, you know how much your checking account is. All of these items, you can see exactly what you have at any given point. And if you know how much you owe on anything, then you can figure out that probably the rest of what's left over is most likely equity. And but again, always defer to your accountant. So the way you're describing it is the way I would say, yes, that to me is also the way I would look at it. But it's always worth looking at if there's something that you are missing when you're going over your financial picture with your accountant or your bookkeeper, to see if there's anything that you might be missing. I think that's important. Does that help you? Does that help clarify it a little bit?
A little bit. I guess I wonder why a balance sheet is a valuable thing compared to, it seems like I would want to see actually an unbalanced sheet. I want to see more assets instead of coming up with the equity portion, because what does the equity actually, what's the value of the equity really? Is that saying that this is the true value of the business, is the equity?
So that's such a good point, right? So we're talking more about more concrete items and things that the business owns. If you're talking about the value of a business, it's a whole different thing. If you're looking at selling your business, you're not just selling inventory, materials, and equipment. You're not just selling property. You're selling it's going to be based more on sales. So it's a very different conversation if you're looking at selling your business and valuing your business. But the balance sheet is going to be a tool that the lenders are looking at. And I think probably what we can do is at the end of the presentation is if anybody who's on the call, I know we do have some BECU representatives that might be able to kind of highlight the importance of what a lender is looking at. Maybe that could be something that they could mention at that point. But the balance sheet is one part of the picture. And you'll see kind of next, we're going to talk about the debt schedule is the next one that we're going to look at. But I agree. And I understand what you're saying is that, well, don't you want to have more assets? Yeah, more assets and less liability. So you're going to have more equity. So it's still going to equal out because of the placement on the balance sheet, if that makes sense. Because your equity is still going to be over on the right-hand side.
Thank you.
You're welcome. Okay, so the business debt schedule is going to take everything that is all of your liabilities, and it's going to put it in a consolidated statement that, again, is very useful to your lender. So these items that are listed here are what's going to be included on that sheet. The creditor or the lender name, so whoever the money is borrowed from, the loan origination date, when the money was first taken out as a loan, how much was that original amount? What's the current balance? So it's going to show kind of how much has been paid down over that time. The interest rate, and that's going to be set up at the time that you take out the loan. The monthly payment. And one thing, the monthly payment may not match what you're paying. So you're going to include though what the required payment is on a debt schedule. If you're making additional payments, you're just going to pay off your loan faster, but it wouldn't necessarily be calculated into your debt to income ratio. And then you'll also want to make sure that you're listing any security or collateral. So if you've had to offer any collateral or anything to back up the money that you've borrowed, and then the maturity date. When is that final payment due? When are you expected to pay it off? So here is a little sample of a business debt schedule. And this just shows two. You may have more, you may have none. So in this example, it lists out two loans. One is for $5,000, one is for $50,000. You can see they were taken out at different time periods. The current balance is very different. But it's nice to have it all in one place, not only for yourself, but for the lending underwriter to take a look and see what your total monthly payments are, what the total balance is, and if there's any collateral used. So on this truck loan, ABC Bank, the truck is the collateral. XYZ Credit Union, 50,000 is the original amount. Maybe the home is listed as collateral and the monthly payment is $518. So this is going to be a statement that any lender is going to request from you to really summarize everything that you owe, but with more detail so they can see exactly who owes or who's getting paid what. Oops, how did I skip ahead? Sorry about that. Okay, so your profit and loss statement. The profit and loss statement, I think, is one of those documents that we probably talk about a lot more. We hear it spoken of a lot more. P&L statement, profit and loss statement, otherwise known as income statement. And this document is going to illustrate financial performance over a specific period of time. So it could be that you're preparing a profit and loss statement for a quarter or a month or a year. And it's going to include these important items. It's going to include your revenues. It's going to include realized gains and losses. It's going to include expenses and your net income and loss. So we're going to go over more of, in more detail. So let's take a look at each component. So revenues and gains are going to be included in that top half. Revenues are your volume of sales. It's the total sales. It's the income that's generated by the sale of your primary good or service that you sell at your business. And gains, those realized gains, are usually going to be referring to business investments. So if you have any, if you're selling any kind of equipment and you've made a profit or you've made a loss on it, anything that's been property of the business that's not necessarily your good or service that is your primary business focus, that would be considered your realized gain or loss. So those two things together are going to show us your gross profit, which is the total. And from there is where you start subtracting out your operating expenses and if you had any losses on anything that you sold, to come down to your net income. And this is super, super simplified. And it really is supposed to be that way. It's supposed to be relatively simple to look at because it's a snapshot, right? So when lenders or investors, um, anybody who's taking a quick look wants to be able to see key pieces of information in one spot. So they can go to this document and see where you're at and what your financial strength looks like. And remember, the net income or net loss, depending on where you're at in time, the goal, right, is to have a net profit, right? You want to be making profits from your business. But maybe if you're early on, if you're just starting with your business, maybe you haven't reached what's called your break-even point. A lot of businesses in the startup period, they're working hard and you're establishing a presence, but you just haven't maybe come over that hurdle of really making lots of profit just yet. So keeping a track of these profits or losses is going to help you when it comes to talking about cash flow projections, which is the section we're going to get to in a moment. But when you're looking at cash flow projections, there's some really important factors to include. And the first part is to look at total sales, which is just mentioned is your gross revenue. So total sales of all of the products and services that you've sold for a specific amount of time, you want to be able to really make sure you're accounting for everything that you've sold. And when I talk about importance of doing business with cash in the future slide, make sure that you're not missing anything. So if you have different ways of selling your product, and what I mean when I'm talking about this, I'm thinking of a hairdresser, for example. And I went to a salon doing a coaching session, and they had cash sales. They had sales done through Zelle. They had credit card sales. So they had a lot of different places where they were collecting payment, which is fine. You may have for your business that you've got multiple places that your customers can pay for their good or service. Just don't forget any of them. You want to make sure that you're keeping close track of every sale that's made, because the more you sell, the better, the more sales you have, the better it looks, because you're demonstrating that your product is in demand. So you don't want to sell yourself short on that in any way. When we're looking at the total cost of goods sold, there's two different types of expenses when we're talking about businesses. And the first is cost of goods sold, or COGS. And COGS vary with the number of sales that you make. So when I'm teaching class, I usually explain that the cost of goods, that could be the material that goes into producing your product. It is any of the packaging. It could be anything that's going to go home with the customer. That's going to be included in your COGS. And I like to use the example of a greeting card business. So think of a greeting card business that has packets of greeting cards to sell. Not only is it the card itself, but you're going to look at the total inclusive package of what goes home with the customer. It could be a box. It could be the cellophane. It could be embossed stickers that are included. It could be a ribbon that you use to tie around the little box or the individual card. Maybe you've got there's fabrics or different things that are included in the greeting card. The more you sell, the more you use of that material, right? So the COG is going to change based on the number of sales you make. The operating expenses, those are fixed or recurring expenses, so they tend to be more predictable. And that's going to be that expense that you're going to have to pay on a monthly basis, regardless of the number of sales that you make. So it could be, for example, when we're talking about the greeting card business, it could be that you've got to pay rent, you've got to pay your internet, you've got to pay for a telephone service, electricity, the list goes on and on. But I get a lot of questions when it comes to certain things like, well, Joanna, what about the embosser that I purchased? Well, the embosser is maybe let's say it's a little punch or a little embossing machine, and it's not something that you're paying for regularly, but it's still, it's still a business expense. So it wouldn't be a cog because it's one price. The price doesn't depend on how many you sell or how often you use it, but it's something that you could either pay for upfront, or if depending on, I don't know how much embossers are. I can't imagine that they would be super expensive, but just thinking about, it's something that maybe it's a startup expense if you're just starting your greeting card business, or maybe you've purchased it and you're going to get different seals that you want to acquire to change the designs. It's still going to be more of an operating expense because it's something that you can use over and over again. It's not a consumable. So those are just a few different rules of thumb to think about when you're taking into account the different expenses that your business might run into. And each of those is going to be part of your profit and loss statement. But when we're talking about cash flow projections, not only are we talking about profit and loss for a given time in the past, but now we're looking at the future. So that's where the difference comes in. The profit and loss statement, we're looking with hindsight at where we've been, and we're using that information to project or to paint a picture of the expectation that you have with your business sales. And sales projections are super important when we're looking at the overall picture of your business, because a lot of times you're going to use that information to determine how much of a loan you need. So if you're taking out a loan for something, then you need to be able to show that you can pay it back. And what do those projections look like? What kind of impact could making an investment in your business provide for you? Now, that's not the only reason why you would have cash flow projections. It's just a useful tool to always be able to kind of map out where you're headed. And I think about different things that might come into play when we're talking about cash flow projections. Remember, it's, future predictions are never indicative of what the results are going to be, right? We never really know where we're going to be, but it helps us put our goals onto paper and set up a plan to achieve those goals. So it might be that you're looking at cash flow projections for a short term, like months up to a year. It could be that you're making a big prediction or projection of the long term for the next 3 to 5 years. And that's fine. It's really whatever your needs are. One thing that's, I think, super helpful to keep in mind are the seasonal effects that can potentially be on your sales. So think about your business, and if you look at the past year, what are your busy times of year? Are you super busy doing business at farmers markets? Or is your business really business around the holiday or fall time of year? What drives your sales, and what effect will that have on your sales projections? Do you have higher sales in summer and fall? You want to make sure that you include that. And think about too, those expense projections. Granted, they're not always predictable, right? Things happen all the time that can derail us. But the better prepared we are, the better we can have a plan in place and always be able to fall back on emergency funds. But if we know, just like what I was saying towards the beginning, about a purchase that needs to be made in the future, or if you've got a goal of something that you want to buy for your business, you can start saving ahead. And you can put that into your projections of, I need to be setting aside $500 each month because I want to be able to purchase this machine for my business. Or also, what are those one-time, so that's a one-time expense that might come up in the future, and having a well-funded emergency fund can help with those unpredictable ones that come up that we don't even want to mention, but stuff happens. A lot of the businesses that I've been visiting have had, unfortunately, windows broken or different things that have come up. They didn't plan on it, but the insurance deductible was the same, if not more, than the cost to repair the damage. So it's always good to be thinking about, what are those one-time things that I can plan for now, hoping they don't happen, but just be prepared just in case they do. So those are some things to keep in mind. Okay. Here is one of our handy dandy templates that show kind of maps out a sample cash flow projection with 3 months. You can find a lot of these types of templates online if that's something that you're looking for. A lot of the programs, the app-based programs and the bookkeeping software, they're all going to have templates like this that you can use. I've seen people using workbooks or just plain notebooks and creating the same type of document by hand, which, hey, if you are good with paper and pen, then go for it. But one of the benefits of having it, like I was saying earlier about it being backed up, is it takes away human error, right? It takes away the risk that you might make a mistake in your calculations. If you're using Excel or something that's based in Excel, a lot of the formulas can be calculated for you, which makes it so much easier. But either way, it's helpful to understand what it is that you're doing and what numbers that you should use in each of these types of programs or templates. Okay, so now just a few notes on doing business with cash. So I did a whole presentation one time on kind of the pitfalls and the risks that some of the businesses fall into, and I don't want to focus too much on negative, but really on the positive, in the sense that the better records you keep when you're doing business with cash is that you're just going to show a healthier business sales history if you keep track of all your cash sales. That's really what it comes down to, is it's going to give a truer picture of the revenue that you're generating. So that includes, that's going to include tip income, any kind of, literally, like you're taking the physical bill in as form of payment. And of course, it's easier to track if it's in Zelle or one of those other programs that they use to do cash transfers. And really, you just really want to avoid not reporting income properly when it comes to cash, because there are IRS penalties for doing that. And you can get into a lot of trouble if you're not being if you're not staying on top of it and really reflecting what your true income was that way. If you pay for cash, because I know a lot of businesses, if you've been taking cash, it's really easy then just to pay your bills with cash as well. always request receipts. Always, always, because that's the best way to prove that you ever paid for something. And it's scary because I did talk to a business owner who told me they weren't, I don't remember if it was just they weren't too worried about it. They knew the other business owner, but word of mouth doesn't do a lot when it comes to the IRS or it comes to record keeping. You always want to have things in paper and you want it recorded. Um, and it helps you stay on track with your budget if you know how much you're paying for something. So you can pay with cash, just make sure that you get a record of it. We're wrapping up with this last section, where to get help. So the first one, Business Impact Northwest. They offer actually all of these. So maybe I should just talk in general about all of them. Clearly, I've been teaching with Ventures now for a long time, but each of these organizations on here offer great resources for the community. Many of them there's a lot of free resources as well, but Business Impact Northwest, Ventures, El Centro de la Raza, for people that want to attend Spanish class, like classes in Spanish, SCORE, and the Washington Small Business Development Center. So each of these organizations, if you need help with any of the pieces that I've talked about today, even if it's just reviewing your business plan and starting with that foundation document, it's a great place to start, and it can lead to so many other areas for review. And I think I mentioned, if you haven't reviewed your business plan in the past year, it's a good time to do that. And with that comes basically reviewing and updating all of your other projections and financial documents, because it all really comes together and it all connects to paint a picture of your business. So it's been my pleasure presenting this information to you this evening. I want to open it up now for questions. If you've got any, I'm happy to address those now. And also, if anybody from BECU from the lending side of things, if there is anybody on the call who would like to answer or address Michal's question, that just for a little additional clarity on her question regarding the value of the balance sheet, I am happy to have you speak up now.
Hey, Joanna, it's
Yes.
Jennifer.
Hello, Jennifer. Thank you.
Hi. Unfortunately, it doesn't look like we have anybody that can answer that specific lending question, but Michal, I can have somebody get in touch with you if you'd like to have a little bit better understanding about, what we would be looking for specifically.
That's all right. I probably can find out on the web myself.
Okay.
It's just always been a thing that I wondered about.
No, it's a very good question. So I might
It's a great question. I'm sorry that I wasn't able to provide more background behind that, but like I said, some of those specifics in terms of on the lending side and why, getting a little bit deeper, it's always good to get another opinion on that. But thank you for bringing that up, because I think it's, there's so many pieces to each part, which I think goes back to this idea of, does it make sense to get help, right? If it's something that we can't do on our own, maybe it makes sense to get the assistance of an accountant or bookkeeper to help us with some of these things where, it may not be our strong suit, right? So, anybody else have any questions this evening? I'm happy to address. I hope you liked the content. Thank you. I hope it was worth your time, everyone. Thank you so much. Again, please go back and attend virtually the first 2 classes that we did on our Introduction to Business Key Considerations workshop series. And we are going to be doing one more for the end of the year. And so please watch your emails for that notification. We will be covering loan preparedness. So that will be the wrap up of what we have done to date. So thank you so much, everybody. Have a wonderful night and hope to see you on the next one. Thank you.
Thank you, Joanna.
Thank you, Jennifer.
Mhm.